For our problem demonstrations, we'll start with exercise 13.2, which covers the periodic inventory journal entries. On January 5th, purchased merchandise on account from prestigious jewelers. So remember, under periodic, the merchandise inventory account is not active. So we put the purchase of merchandise in the purchases account. And it was on account. On the 8th, we paid freight charges on merchandise purchased. So under the periodic method, the freight account is separate. Okay, and it said we paid those, so we're going to debit freight and credit cash. Remember, under the perpetual method, the shipping or the freight would be added into the price of the merchandise. We would just debit merchandise inventory. On the 12th, we sold merchandise on account to Diamonds Unlimited. So for the periodic method, we simply record the sales, which is debit accounts receivable, credit sales. We've seen this entry many times before. And then on 15, it says, received a credit memo from prestigious jewelers for merchandise returned. Okay, so that means that we have returned the purchase on January 5th, or a part of that purchase. Okay, so we are making a return. So that's related to the January 5th purchase. So we can just flip this entry upside down, debit accounts payable, and make sure you credit the purchase returns and allowances. And that was for $700. And then on the 22nd, we issued a credit memo to Diamonds Unlimited. So remember, Diamonds Unlimited is our customer. So this is going to offset an accounts receivable. So this is a sales return and allowance. And that's related to this entry here on the 12th. So we're just going to flip this entry and debit sales returns and allowances and credit accounts receivable for the $900. Okay, next we'll look at entries under the perpetual method. Remember, the perpetual inventory method is where the merchandise inventory account is active and we're constantly updating the inventory account. Under periodic, it's only updated one time a year, which was at the end of the year. So on March the 3rd, we've purchased merchandise on account from City Galleria. Okay, so since we're using perpetual, we're adding that inventory to our merchandise inventory account. And then on the 7th, we paid freight charges on merchandise purchased for $225. Remember, there is not a separate freight in account under the perpetual method. So those freight charges go straight into merchandise inventory and add to the cost of the inventory. Okay, on the 13th, we sold merchandise on account to Amber Specialties. The cost of the merchandise was $2,200. Under the perpetual method, there are two journal entries. One to record the sale, and the second is to move the inventory out of merchandise inventory because we no longer have it. So we're going to record the sale at the sales price. And then we're going to now move the inventory out of merchandise inventory at its cost, and we're moving it into cost of goods sold. Then on the 18th, we received a credit memo from City Galleria for merchandise returned for $6.50. Okay, so this is a purchase that we've returned. So we are going to, let's see, that was here. We're just going to flip this entry. We're going to reduce our accounts payable to City Galleria, and then we're going to reduce our merchandise inventory because we returned it. Okay, that was for $6.50. And last, we issued a credit memo to one of our customers for merchandise returned. The cost of the merchandise was $3.20. That was the Amber Specialties transaction. So we're just going to flip that and debit sales returns and allowances and credit accounts receivable at the retail price, the price we charged our customer. And then in the next entry, we're going to increase our merchandise inventory account because the merchandise we sold is now coming back to us. And we do that at the cost. So remember, merchandise inventory always has the cost of the items in that account, never the retail. Okay, and we credited cost of goods sold because up here we had increased it. So if the merchandise that we sold is returned, then we'll have to reduce our cost of goods sold. The next exercise we'll look at is exercise 13.4, and this exercise deals with year-end inventory, which amounts should be included and which amounts should not be included in the ending inventory. Okay, so first of all, we have the cost of the merchandise on the showroom floor, and of course that would definitely be included. So I'm going to go ahead and add that in. And then we have goods held on consignment. The consignor or the owner is National Manufacturer. Those are not our goods, even though they are in our showroom, they belong to National Manufacturer. So we would not include the $6,400. Then we have goods. We are Chin's Chattels, the name of our company, and we are the consignor, and we have goods for sale at the location of the Grand Avenue Vista. So those are our goods. That is our inventory, even though it is not in our showroom, it's in someone else's. So we would include the $4,400. Next, we have a sales invoice, and it says that merchandise was shipped on June 29th and delivered to the buyer on July 3rd. Now, year end is June 30th, so these goods are in transit. So the way to determine who the goods belong to is to see who's paying the shipping. So on this one, we have shipped these goods FOB shipping point. That means that the buyer is paying as of the 29th. Those goods belonged to the buyer as they were shipped. So we would not include the $3,800. In the next sales invoice, merchandise was shipped on the 25th. It arrived at the buyer's dock on July 5th. These are also in transit, but they were sent FOB destination. That means that we paid for the shipping until it arrived at the destination. So since we're paying for the shipping, these were our goods, so we will add those in. Okay, so the total that I'm getting is $43,600 plus 4,400 plus 4,000 will give me 52,000. Check that figure to make sure that's correct, and it was. So now we'll move on to exercise 13.5, and this deals with the inventory methods. We're going to be looking at FIFO, weighted average, and lower of cost or market. First, we're going to calculate the amount that's going to be assigned to our ending inventory. And the first method is FIFO, or first in, first out. So our first units that we purchased are the first ones that we've sold. One important thing that you always need to check when you're working with your inventory systems is look to see how many units are left in ending inventory. So we have 10 units in ending inventory, which means that we must have sold 30. If we've got 40 units and we still have 10, then 30 were sold. And since we're working with FIFO, the first 30 are sold and the last 10 are in ending inventory. So since they're asking what is the amount assigned to ending inventory, that's going to be 10 units at $30. So that's 300. For weighted average, we're first going to determine our weighted average cost per unit. So to do that, I'm just going to take the total cost and divide it by the total number of units. And that's going to give us $24.25 each. Now they're wanting the ending inventory value. So I have 10 units that are valued at $24.25. So if I multiply those figures together, 10 times $24.25, I get $242.50 as the value of my ending inventory. Okay, so now we're going to do the lower of cost or market with FIFO and then also with weighted average. So if I use the FIFO inventory method and also employ lower of cost or market, I am going to either use this 300 that I've already calculated or the market value, whichever is lower. So in the problem, it's telling us that the market value, which is the cost to replace the item, is $26 per unit. $26 per unit times the 10 units in ending inventory gives me $260. So now I'm going to choose the lower of the two, $260 or $300. So I'm going to choose the $260 because the inventory has actually lost value while I've been holding it. Okay, and now we will assume we're using the weighted average inventory method and we're going to employ lower of cost or market with it. So we already know that the market value is 26 times 10, so that's 260. My weighted average value is 242.50. That's the value on my books. So I'm not going to do anything. I'm just going to leave my books the way they are because I have the lower value. Now, when your inventory is written down, like in number 1 or number 2A, we had our inventory at 300, but then we wrote it down to 260 because market was lower. So we've got a $40 loss that we need to take. So in order to do that, we're going to debit loss on write-down of inventory, and then we're going to credit our merchandise inventory to bring it down by $40. So what this does is it moves the balance down from 300. If I have 300 in my merchandise inventory account and I credit it for 40, then that number becomes 260. So I'm going to record a loss on that write down. On B, we didn't write anything down. We left our balance at what our books had. We had our inventory valued at $242.50, and it's going to remain there because that was the lower between the lower of cost or market. So there would be no entry required for B. Okay, on exercise 6, we're going to get in a little bit deeper into our inventory costing methods. We're going to look at specific identification, FIFO, LIFO, and weighted average. Okay, so the first method, let's see, that we're dealing with is FIFO, first in, first out. Okay, remember with your inventory methods, you need to find out how many are in ending inventory and then calculate how many you sold. So I have 13 units in ending inventory, and if I had 4,000 and I still have 1,300, that means I sold 2,700. So under FIFO, the first 2,700 were sold and the last 1,300 are still in ending inventory. Now we need to apply a value to those 1,300. So I'm going to start with my last purchase. 700 at 27 cost $18,900. 200 was the next purchase at 26 for 5,200. So that gives me 900 units. Now I need 400 more units from this June 2nd purchase. So 400, 200, and 700 are 1,300 units. So 400 times 25 is $10,000. So to get the value of my ending inventory, I'm going to take 10,000 as the value of the 5th purchase, 5,200 from the 6th purchase, and 18,900 from the 7th purchase. That gives me my 1,300 units, and that totals 34,100. Okay, now if I know my ending inventory, I can calculate my cost of goods sold by subtracting the 34,100 from my goods available for sale of 95,600. So 95,600 less 34,100 is 61,500. Now I could have done that the hard way and counted 2,700 units from the top because it's first in, first out. Those were the first I sold. So it would have been all 400, all 500, all 200, all 300, all 900, and then 400 from this purchase would have equaled 2,700. And then I multiply them across in order to get their value, add them together, and I would come up with 61,500. Okay, so now let's do last in, first out. Okay, LIFO means that the last items I purchased were the ones I sold, and the first items that I started with and purchased are the ones still in ending inventory. So the last ones in were the first ones out. So the last 2,700 are sold, and the first 1,300 are in ending inventory. Okay, so I'll take all 400 of the beginning inventory, 500 from October 18th, and then I'm up to 900, and then all 200 here, that'll give me 1,100, and then I'm going to need 200 from this third purchase to equal the 1,300. So 400 and 500 is 9, 10, 11, and then 200 here. So 200 times 23 is $4,600. So the value of the 200 units on the third purchase is $4,600. And so I'm going to add the 4,300, all the units from the second purchase, all the units from the first purchase, and then the value of all the units in the beginning inventory. So that gives me $27,150. Okay, that's my ending inventory. And since I know what my ending inventory is, I can subtract that from my goods available for sale and get the cost of goods sold. So 95,600 less 27,150 gives me 68,450. And once again, I could have done this the hard way by getting the value of the last 2,700 units. So that would have been 700, 200, 800, 900, and then 100 from the third purchase, because the 200 was in ending inventory. The remaining 100 must have been sold. Okay, weighted average. Remember, first step in weighted average is to come up with an average price per unit. And you do that by taking the 95,600 and dividing it by 4,000 units. So total cost divided by total units. And that gives me $23.90 per unit. So to get ending inventory, I need to take 1,300 units times the $23.90, and that would give me $31,070 in ending inventory. So I can do the math. I can subtract the 31,070 from 95,600 to come up with my cost of goods sold, which would be 64,530. Or I could take the number of units I sold, which was 2,700, times the 23.90 price per unit, and come up with 64,530. So you can actually check yourself to make sure you've got the correct cost of goods sold. You can do it two ways and make sure you come up with the same number. The last method is specific identification. So that means that the company can specifically identify which items they still have and which items they sold. And that is the reason you have all this extra information here. So on this problem, make sure you're only for LIFO and FIFO and weighted average, you're only working with these figures. You only need this set of figures for specific identification. So this one tells me that of the 1,300 units, these are the ones that are still in ending inventory. So let's see, that's 13, 3, 4, 8, 9, 10. That's 1,300 units right there. So 100 of these are from the first purchase. So 100 of these are from the first purchase at $20.50 would give me $2,050 to add to my ending inventory. 200 are from the third purchase. So I go to the third purchase, and 200 at $23 is $4,600. So that would be added to the ending inventory. 100 are from the fourth purchase, so 100 at $24.50 will give me $2,450 to add to ending inventory. And 400 are from the fifth purchase, so 400 at $25 is $10,000 to add to ending inventory. And 200 from the sixth purchase, so all 200 of those at $5,200, and then 300 are from the seventh purchase, so 300 at $27 will give you $8,100. So to get my total ending inventory, I'm going to add up all those figures we just came up with. 2,050, the 4,600 from the third purchase, the 2,450 from the fourth, the 10,000 from the fifth, 5,200 from the sixth purchase, and then 8,100 from the seventh purchase. And those figures total up to 32,400. So I can easily back into my cost of goods sold by subtracting the 32,400 from 95,600. So my cost of goods sold there is 63,200. Next, we'll move down to problem 13.8, where we're going to estimate our ending inventory based on some of the figures we already know. I'm going to move over to an Excel file so that you can actually see the calculations in the problem. This is the gross profit method in number 8, and we're going to use the figures that are provided here to calculate an estimated ending inventory, because sometimes we don't want to wait to the end of the year to do a physical inventory, or we just don't have time to do a physical inventory. So in this case, a fire completely destroyed all the inventory of Glisten lumber. So they are trying to figure out what their inventory was as of August 5th. And to do this, you need to know the cost of goods sold formula, which is beginning inventory plus purchases, which will give you goods available for sale, less, it's usually less ending inventory will give you cost of goods sold, but we know cost of goods sold. In this case, we're trying to estimate the ending inventory. So most of the numbers are given, and you have to do a short calculation for cost of goods sold to end up with your ending inventory. So we're going to just take the numbers they give us and plug them into the formula. So beginning inventory is 100,000, and net purchases are 420,000. And that's going to give us a cost of goods available for sale of 520,000. So that's everything the company could have sold up to August 5th. That's all the inventory they had. For the next line, we're not given cost of goods sold, but we can get to it pretty easily with a short calculation. So they've given us net sales, and they're telling us that 40% of those sales is our profit. Remember though, we're not looking for profit, we're looking for the cost of goods sold. So if of this number 40% is profit, the other 60% has got to be our cost. So if we take 732,000 and multiply that figure times 60%, not 40, that's the profit. 60% is the cost. So if we did 732 times 60%, we would get a cost of 439,200. So that leaves us with an estimated ending inventory of 80,800. So that tells us that that is how much was destroyed in the fire. So the only, thinking pretty much you have to do for this problem is calculating the cost of goods sold. So if you were given a gross profit percentage of 30, then you would know the cost would be 70%. If you were given a gross profit percentage of 25%, then you would know cost of goods sold would be 75%. Okay, so let's move on to the retail method. Now the retail method is in number 9 of your problems. It's problem 13.9 in the book. And we're going to follow this same formula pretty much. Beginning inventory plus purchases gives you goods available for sale, less cost of goods sold gives you estimated ending inventory. But what we're given this time is our figures at cost and then also at retail. So down below I have the formula, and then I have two columns, one for cost and one for retail. And now I'm just going to start moving the figures that I'm given down into the cost of goods sold formula. So the beginning inventory is at cost $32,000 and at retail $52,000. The net purchases are $176 at cost and $268 at retail. So now we have our goods available for sale both at cost and at retail. Now the next line in the formula is to subtract cost of goods sold. Well, we don't know what our cost of goods sold is, but we do know what our net sales for the period was. So remember, our net sales is just really our cost of goods sold marked up at retail. So I'm going to enter the $260,000 next under cost of goods sold on the retail side, and that gives me the estimated ending inventory at retail. I need to know what my estimated ending inventory is at cost. So to do that, I'm going to use my goods available for sale figures up here. And with these figures, I can get a cost to retail percentage. If I divide my $208,000 cost by the retail $320,000, I get a cost to retail percentage of 65%. And what that means is that 65% of my retail is my cost. So if I know my estimated ending inventory at retail, then I can take 65% of that and get my cost, which is what is going on here. So 60,000 at 65% gives me estimated ending inventory at cost of $39,000. And since we have our goods available for sale at $208,000, if I subtract my ending inventory at cost, I can get my cost of goods sold at $169,000.